Imagine you've invested your hard-earned money in a company, becoming a shareholder, a part owner. What would you, as a shareholder, want the financial manager of that company to focus on? Essentially, you'd want them to make decisions that benefit you, the owner. And what does benefit mean in this context? Generally, shareholders want the financial manager to maximize their wealth. Now, let's break down what maximizing shareholder wealth actually means. Think of it like this. When you buy shares in a company, you're buying a tiny piece of ownership. The value of that piece, your share, isn't fixed. It goes up and down based on how well the company is doing and how well it's expected to do in the future. Shareholder wealth maximization is all about increasing the value of your ownership stake, making your shares more valuable over time. This isn't just about making a quick buck today. It's about creating sustainable, long-term value. Financial managers achieve this by making smart decisions about where the company invests its money, how it finances its operations, and how it manages its assets. Consider a simple example. Imagine two lemonade stands. Stand A, run by a financial manager focused on maximizing shareholder wealth, decides to invest in better lemons and a prime location. This might cost more upfront, but they believe it will attract more customers and lead to higher profits in the long run. Stand B, perhaps focused on short-term profits, chooses cheaper ingredients and a less visible spot to save money immediately. In the short term, Stand B might show slightly higher initial profits. However, Stand A, with its better quality and location, is likely to build a loyal customer base and see its profits and overall value grow significantly over time. Shareholders of Stand A would see their investment become more valuable because the stand itself is more valuable and has brighter future prospects. This idea of long-term value is crucial. Shareholder wealth maximization isn't just about boosting profits this quarter at the expense of future growth or ethical considerations. A truly effective financial manager understands that sustainable wealth creation involves responsible practices, ethical behavior, and investments that build the company's long-term strength and reputation. Think of a company that focuses solely on cutting costs by polluting the environment or mistreating its employees. While they might see short-term gains, in the long run, this approach is likely to damage their reputation, face legal repercussions, and ultimately decrease their value. So, how do financial managers actually maximize shareholder wealth? They do this by making decisions that increase the company's overall value. This value is often reflected in the company's share price. A higher share price generally indicates that the market believes the company is doing well and has a promising future. Financial managers influence the share price through various actions. Investing in profitable projects, managing risk effectively, and ensuring the company is financially healthy all contribute to a higher share price, and thus increased shareholder wealth. In essence, shareholders, as owners, delegate the day-to-day financial decisions to financial managers. The underlying expectation is that these managers will act in the best interest of the owners, and the primary way to do that, from a shareholder's perspective, is to make decisions that ultimately increase the value of their investment, maximizing shareholder wealth. This is the guiding principle that shapes the financial decisions within a company and reflects the fundamental goal from the perspective of those who have invested their capital.